Good afternoon. How is everybody? Doing okay? Have these guys had lunch yet?
Yeah.
Okay, good. So I think what you need is a stretch break. You just had lunch. So everybody get up. Get up. And then just high five the person on your right, since these are all round tables. It should be a circular motion. And don't do more than a high five, okay? Great. Now you can sit down. Good. All right. Now you get to know each other, and hopefully at least you'll stay until 3 o'clock until KJ's session. All right. Good. Do I have a presentation, or this is a? Great. Let's see what they have prepared for me. This one? Well, I'm going to talk about live IoT about Jay. No slides, right? Okay. So one of the things we do at, if you're familiar with Draper University, we recruit 18 to 28-year-old students, and we teach them about entrepreneurship. And one of the lessons we teach them is that when you're on the stage, everything goes on. You never complain about technology. You never complain about slides. I was in Korea last year, and then they put up the wrong deck. I thought it was interesting because I just kept talking, and it was the wrong deck, and it worked out okay because no one knew except for me. But in this case, obviously, you knew that the deck weren't here. We actually teach that to our students. So I've been a venture capitalist for about 20 years. So my talk today was going to be about what I observed in the last 20 years, the similarities between corporate venture and seed investing. On the first thought, most people would say, well, there's nothing, it couldn't be even more different, right? These two completely different types of people, the investments they make. You could call them the different asset class, but it just couldn't be more dissimilar. So I had the privilege of starting my career as a corporate venture capitalist at Siemens and then at ABB. And on the side, I also did a lot of angel investing. And what I saw was actually quite a bit of similarities as these two group of people and the things we did kind of converged in the last 20 years. And I'll give an example. This crowd is not, I say I kind of fit in very well because there are some younger crowds. When I try to tell them the difference, they're like, whoa, what are you talking about? Isn't this just everybody's the same? But in 20 years ago, corporate venture was very different, right? Corporate venture, we were essentially corporate employees making investments for our parent company. And then angel investing, on the other hand, these were high net worth individuals, which basically is everybody in California based on the way they determine who a high net worth individual is, right? Essentially, everybody who pays a lot of taxes is a high net worth individual. So these people would basically make investments early in companies, right? On the surface, very different, right? But the reality is that from a financial investor point of view, and this is when I was a corporate VC and I was making seed investments, we were both dumb money. I was very, very excited. I got a call from Sand Hill Investors. This is when I was at Siemens. I said, wow. They called me. They wanted me in this deal, right? And very quickly I figured out when you get a call, it may not be a good thing, okay? Because there is a pecking order, right? So you talk about the bust of the year 2000, right? The boom and bust of the internet. A lot of people got burned. The angels got burned, and the corporates got burned, right? Fast forward the clock, okay? Now things have changed. What has changed between year 2000 until now? I'll give you sort of a quick rundown, right? In the year, I'm kind of dating myself, but roughly between 2000 and 2010, the time becomes a continuum. There's something called the AWS, and then the Microsoft Azure came out. Suddenly, the idea of raising $5 million for a Series A so you get to a prototype, that's no longer the case, right? That single change in the Amazon business model and the declining cost of computing and communication suddenly lower the entry barrier for startups. Okay? A few things happen. One tangent to my talk is there's a phenomenon called the Y Combinator, right? The idea of you could start a bunch of companies at very low cost, enable a lot of people, and that enabled a lot of angels, right? Angels like myself, who would write small checks, $5,000, $10,000, and just kind of pass the hat, and you put people in business, right? And guess what happened? That happened on the angel side. On the corporate side, what do we notice? We notice suddenly we no longer have this monopoly on innovation, right? I remember when I started venture in the early 2000s, late 90s, our job was pretty simple. I kind of look up the phone book and figure out, hey, who worked at Bell Labs? I'm just going to call their friends, call them and their friends. Suddenly I kind of figure out who all worked at Bell Labs, who read the same paper, they were the same research group. Sure enough, all the IPO companies from the optical component days, they all trace their lineage back to a few labs, right? But unfortunately, or fortunately, in the next 10 years, innovation has truly democratized, right? You no longer have to be part of that little elite club, right? You suddenly have open source movement, right? You have cloud computing. So information itself is efficient, right? Not a lot of secrets anymore, right? In fact, the internet had made these technical papers online readily available. You don't have to be going to a library digging up, papers. So information is sufficient, right? And the borders are becoming lower. So suddenly someone who's working on a development project on the West Coast could collaborate with the East Coast, right? And this movement actually continues until today. You guys probably are familiar with some of the work we have done at the Draper investment funds. We are a proponent and a forerunner in the blockchain. And that is, in fact, the best example of cross-border collaboration, right? You have these white papers and these projects, that are called, right? They are not even companies. You have collaborators from lots of different places, right? So corporates realize, wow, these innovations could happen outside of my labs, right? And it finally happened. So corporates are moving earlier and earlier into the innovation cycle, right? And suddenly, NIH, you're always going to have that in large companies. But I think it's becoming more and more on the minds of the key executives, right? They are being more open-minded. So you now have corporate ventures start going to demo days, right? Next to the angels, okay? And guess what happened? What happened was that corporates are becoming also more entrepreneur-friendly, right? When I started, we used to ask for terms like right of first refusal. I often have these long conversations with my committee members on the corporate side. They say, well, why would we invest in startups if we cannot get their IP? At first I was like, oh, that's true. Why would you invest in startup if you can't get their IP? But if you think about it, if you're a startup, why would we want to get your investment if you want to take our IP? Right? So those conversations, they don't happen anymore, right? This idea of a ROFR, we don't even have to explain to our co-investors on the corporate side. We don't even have to explain to people, if you're a corporate investor, you get on the board, your fiduciary duty is to the company, right? And not to the corporate people. So we no longer have to educate people. In the last 20 years, corporate investors have become very, very entrepreneur-friendly. And angels have always been entrepreneur-friendly. So I kind of argue this idea of venture investing now has converged, right? When we look at our early stage investments, when we think about who we want to recruit as investors, angels, corporates, financial VCs, in our minds are all the same. It's just people adding value in different ways. So I have a minute left. I just want to quickly do a commercial on what we do. My name is Tang. I'm the CEO of Draper University. I'm also a partner in the Draper funds. We have 23 funds around the world. We have $3 billion under management, and we back entrepreneurs when they typically see their first institutional round. And I'd love to talk to all of you after break.